In 2011, the United States credit rating was downgraded. This caused the S&P 500 to sell off 6.5% the following trading day. And guess what just happened? The United States credit rating was just downgraded. So things are about to get a little tricky out there. And I want to show you guys this because this is what you need for success. It's hanging over there on the wall all the time, but I'm sure you guys probably can't see it. Hustle, motivation, belief, discipline, focus, flexibility, failure, risk, persistence, and patience. And a lot of these are going to be tested over the next month or so. And today as well, you also got a warning from none other than Tom Lee and Fundstrats, saying that August could be a rocky month. And that's actually what we were going to talk about in this video until the US credit rating just got downgraded. And that is a little bit more pressing, but we'll talk about Tom Lee's warning as well and how significant that could be. So let's go ahead and get into all of this information. This is a video that you need to share with everyone out there because this is directly going to affect markets. And if history is any guide, it could be very important. So what just happened is Fitch Credit Ratings has downgraded US long-term rating to AA plus from AAA. Fitch Ratings cut the United States long-term foreign currency issuer default rating to AA from AAA. The agency had placed the country's rating on negative watch in May, citing the debt ceiling fight in Washington. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management, Fitch said. U.S. stocks futures opened lower Tuesday after the downgrade. Only other time the United States has seen its credit downgraded was back in 2011. And you have to go in the archives of the internet. Look how ancient this web page looks from CNN Money. I don't even know if it's called that anymore. I don't look at CNN. But the S&P downgraded U.S. credit rating on August 6th, 2011. And guess what happened the next following day? You were down 6.5% in the S&P 500. You actually got downgraded on a Sunday. So that next following Monday, you dropped 6.5%. I don't know if we're going to get something similar to that. It's a little bit different what kind of market environment that we're in right now. But it's not a good thing. It's never really happened before besides one other time, and if history is any guide, it's not going to be a good outcome. Fitch cited the worsening political divisions around spending and tax policy as a key reason for its decision. It said U.S. governance has declined relative to other highly rated countries, and it noted, quote, repeated debt limit standoffs and last-minute resolutions. Another factor in Fitch's decision is that it expects the U.S. economy to tumble into a mild recession in the final 3 months of this year and early next year. Economists at the Federal Reserve made a similar forecast this spring, but then revised it in July and said growth would slow, but a recession would likely be avoided. I strongly disagree with Fitch's decision, said Treasury Secretary Janet Yellen in a statement. The change announced today is arbitrary and based on outdated data. Yellen noted that the U.S. economy has rapidly recovered from the pandemic recession, with the unemployment rate near a half-century low and the economy expanding at a solid 2.4% annual rate in April through June quarter. A deal to resolve a standoff over the government's borrowing limit in June included over $1 trillion in deficit reduction and improved our fiscal trajectory. That's over the course of like 10 years. So you could disagree with what Fitch did all you want, but what we know this does cause is higher interest rates on notes, bills, and bonds. That is very negative for the stock market, for the economy. You're already seeing bond yields breaking out to almost new highs of this cycle. This is the 10-year bond yield, and it's sitting at 4.04%. This is almost the highest that you have seen in recent times. The highest would be 4.22%. After this downgrade, it's likely that the 10-year treasury, as well as shorter-term treasuries, do make their way higher. What this does is specifically bad for companies that have a lot of debt or companies that revolve around credit. Unfortunately, a stock like Tesla would fit under the credit part. Tesla has very little debt. It's in a very good situation financially. But if your bond yields continue to go higher, that's going to force more people out of buying that new vehicle. The NASDAQ right now is down 0.40%. S&P is down 0.33%. I think you really need to see how the Europe markets as well as the Asian markets react to this once they start trading, and how investors feel about this, because global investors overnight tonight, they could start to make bets on the US, kind of like shorting US stocks and whatnot. That could affect our markets, and I think this could take a little bit of time to fully play out. Tomorrow's obviously not going to be the greatest day in the markets, but we also have big earnings throughout the rest of this week that will be very important. Notably, you're going to have Apple and Amazon Thursday after hours. Apple's market cap, I've said it before and I'll say it again, is over $3 trillion. That's larger than the entirety of the Russell Index. Your Russell 1000, Russell 2000, Russell 3000. Add all of those companies together and you're not over Apple's market cap. So that's important. If Apple or Amazon have bad earnings, it's going to be really negative. If they have good earnings, it might help offset some of this bad news that we just seen from Fitch. Now let's listen to this warning that Fundstrats and Tom Lee made about 7 hours ago today. It says, very possible we could have a painful drawdown in the first half of 2024. And he also thinks August could be a really weak month for the markets as well. This is in stark contrast to what we have seen in the past from Tom Lee. Tom Lee was the one guy, and literally the only guy, that was telling people to buy technology stocks in the second half of 2022 and the first quarter of 2023. He did not look very credible, nor was he well liked when markets were falling. Funny how that is. Well, now he's, the one that got it right. The one person. Because the stocks that he told people to buy were not oil, energy related, or healthcare, or defensive, low multiple stocks. They were your FANG stocks. Your stocks that are up 100 to 500% from the lows. So when he gives you a warning, probably best to listen.
Let's continue this conversation with Fundstrat co-founder and head of research, Tom Lee. Tom, great to have you with us. You're also in the camp that August could be tricky.
Yes, I think August is tricky because, as Bob mentioned, people are on vacation, so it's more vulnerable to sort of shocks. And I think we're in a period where we're going to be nervous about good news. We don't want a good jobs report, or we don't want strong PMIs, because that brings September hike back on the table, along with the 10-year where it is. I think it's very possible we could have a pretty painful drawdown in the first half.
You've been bullish when others have not been.
Yes.
Through the first half of the year. And now that you see strategists sort of bumping up their price targets for year end, Bob was talking about the extreme bullishness now. Does that make you just worry?
Yeah, I think it's a bad sign. Yeah. I think we know the strategists tend to reflect the buy side, and all these price target hikes are chases of a market that's already extended. And then we have August, which is seasonally kind of bumpy, and I am kind of worried that we're going to get some good jobs data, like strong job numbers. People are going to start thinking September and higher rates. Oil's already rising. It feels like it could be pretty messy.
So how do you see the path of the markets going into the fall? The fall is traditionally, seasonally, a difficult period, particularly September, October.
Yeah, I'm sorry. All these things I mentioned are just tactical because I think the second half is going to be really strong. But to me, it's a broadening of the market. It's more about the industrials really responding to the PMI's bottoming, and it's energy reflecting the rise in oil. And so I think it's a broader market, but we could still finish over 4,800. Well above it on the S&P.
I mean, we're seeing that today with Caterpillar and Eaton, for example, advancing. That said, Bob just raised that idea of a sort of a valuation ceiling and the fact that we may be hitting or bumping against it in terms of where PEs are, based at least on the earnings we've gotten so far. Do you worry about overall valuation levels?
Yeah. The reason I'm less worried about valuation is so many clients tell us valuation's a problem. And so when you know that that's already top of mind for clients and they're already being selective, I think the valuation problem tends to be in the mega cap, and the, X the top FANG, we're at 16 times. That's pretty reasonable for a 4% 10-year. So I think
you're just taking out, although Meta, frankly, trades below many of the others, but you're taking out some of the big guys, and then you get down to 16. Is that a way to justify it, or is it still?
That's how our clients pick stocks, right? Because they don't have to buy the FANGs.
They don't? Really? Don't they all just chase?
If you're indexing, right?
Yeah.
If that's your comparison.
That's right. And then if someone's making a case for FANG, imagine someone's thesis is don't buy it because it's expensive. That you would have avoided it for 20 years. So you can't take FANG and say that's a reason not to own it because it's expensive. They've always been. But the rest of the market is pretty reasonable. So I think there's a reason to own both.
But if valuation is not a worry, then 4% shouldn't be a worry either.
It's not. It puts stress in people's minds, but you're absolutely right. The 10-year averaged 5.3% from 1990 to 2007, and the market's total PE was 18 times. We're at 16 times ex-FANG, so there's still room for plenty of multiple expansion. And, it's a good environment for companies when the bogey's 4% on 10-year because it also limits competition, right? Capital formation slows, so the dominant companies actually make more money.
So what Tom Lee said there is he expects a broadening out of this market. What that means is your big tech names either stop going up or they come down. And money goes from those big tech names into other parts of the markets. You've actually been seeing this happening to some degree or another over the past couple of weeks now. You've seen your small and mid cap stocks really outperforming. Now, good news is when it comes to Tesla's not in that big tech category. It is to a certain degree, but it's not in the same category as Apple or Microsoft. It's not seen as a safety kind of trade. It's seen as a high growth trade, kind of like your small and mid cap stocks. Now, we'll ultimately see what happens. Tom Lee said this before Fitch downgraded the credit rating. So I think tomorrow is going to be a real test of how the markets are going to respond to this. Now, in case you're curious, Tesla's average stock return for the month of August is, well, pretty bullish. Tesla usually has a return of 7.58%, according to data that was retrieved on July 21st. Tesla, since the company IPO'd in 2010, has a 54% win rate in the month of August with an average return of 7.5%. One of the stronger months for Tesla, although it looks like June is the best month for Tesla. January, November is the second best month, and January is the fourth best month. This looks like the fifth best month for Tesla, so it's not a terrible month for Tesla. Tesla's usually in the green for August, but again, this is obviously very arbitrage, and it's going to vary depending on what's happening in the markets. So again, the last time we had our credit rating downgraded for America was August 5th, 2011, or August 6th, 2011. The next trading day, the markets fell 6.5% on the S&P 500. The markets were falling for about 2 weeks before this happened. The debt ceiling crisis, the issues that were going on at the time had a role to play as well. And people thought that we were going to get downgraded. So that's the reason the markets were actually falling as well. This drawdown in total was about 21%. Markets are obviously in a much better place today, arguably extremely overvalued. So history does not have to repeat itself, but I think it would be quite ignorant to think stocks could not fall. Now, for those of you guys that are longer term investors, this is the gift that hopefully you have been waiting for. There's also an opportunity to hedge to the downside, to protect your portfolios, and to hopefully make a lot of money. If you guys want to come hedge your portfolio and come trade with us every time we make trades, we post alerts, we'll link down below in the description of this video. That's going to do it. Hit the like button and subscribe to the channel on your way out. Most importantly, enjoy the rest of your day, and I will see you in the next one.